Let's take a look at Chapter 9, which deals with the cost of capital. And the big topic will be the WACC, weighted average cost of capital. And the main components of capital are debt, preferred stock, and common equity. We always look at this big slide here at the beginning of every chapter. So we're down here. What is the weighted average cost of capital? How do we come up with that? What goes into it? Stuff like that. So keep in mind we're kind of looking at corporations, and so the three main sources of capital: long-term debt, preferred stock, and common equity. Now with long-term debt, it says here some companies use permanent short-term debt to finance things like inventory. Other firms have temporary short-term debt or seasonal fluctuations that, and they usually don't really take that into account to pay for with long-term debt. They'll use short-term debt to pay for those fluctuations in inventory to kind of ramp up for the holiday season and so on. So the capital components, sources of funding that come from investors. So that would be your debt, again, your common equity, your preferred equity, but this does not include accounts payable, accruals, deferred taxes, accrued payables, things like that. So those kind of just happen along the normal course of business and are a separate item from the other items that we mentioned. And we also have to focus on things being after tax. The cost of debt being the main one here. When it deals with that, we get a tax break for having debt because the interest expense is tax deductible. Keep that in mind. So we want to focus on the after-tax cost of debt. We also want to focus on the forward or on the future. So this says historical versus new, embedded or marginal costs. And the thing about the WACC is kind of a forward-looking number. We're going to use a number to make some really long-term big decisions that affect the future. And so because of that, we want to focus on the new or the marginal cost of capital. So that'll come up when you do some of the homework. So how do you come up with the cost of debt? So as a company is trying to figure out the WACC, what is the cost of debt? Well, you can ask an investment banker what would be the coupon rate on new debt. If we were going to go out and issue new debt, what would that be? We could look at the bond rating for the company and use the yield on bonds with a similar rating. Or we could find the yield on our debt if we already have some. So 3 ways. Each way is just fine to use. You could potentially use all 3 and do an average, depending on the company and if you already have debt or not. But those are all options. So a common thing that you'll see when you do the homework for the chapter is if we have a potential bond issue, what would the rate be? And so this should look familiar. This comes from Chapter 7. And in Chapter 7, that's when we priced bonds. Remember, we're looking at the present value of an ordinary annuity. And we're looking at a 15-year bond, 12% semi-annual interest that sells for $1,153.72. Remember, this is based on $1,000. And so remember, it's semi-annual, which means I take 15 and I double that to become 30. The present value, what it's worth today, is the $1,153.72. The payment is $60, and then the future value is $1,000. And so remember that with semi-annual, when you're solving for the rate, you have to then double it. So I'd get 5%. If I went to the Excel and I used the present value of ordinary annuity, I have to double that to get to the 10%. Or actually, I'd be solving for the I, solving for interest. Double that, and I get to 10%. And then they would take that 10% and we use the after-tax rate. So remember, with the new tax law, the corporate rate's 22%. The book uses 25 to factor in the possibility of state tax. It's just a nice round number. So I think 25% is the number you'll see the most when you do your homework. But don't always assume it'll be 25. They might change it up on you just a little bit. So 10% times 1 minus t. So the after-tax yield is the before-tax yield times 1 minus t, which becomes 7.5%. Now they talk about flotation cost. And the flotation cost is if we were to issue a new security, common stock, preferred stock, or debt, there'd be a commission to pay to the investment banker that helped us to do this. It's called flotation cost. And so they're saying ignore it for now. They'll bring it in the future, though, and talk about it with something else. Okay, so cost of preferred stock is the next one, and in Chapter 7 we talked a little bit about preferred stocks, and you can see with this one they are going to use a flotation cost. So the return of preferred stocks, basically the cost of preferred stock, is the dividend divided by the price times 1 minus F. Now, when you do the homework, some questions may not give you flotation, some will. Just imagine if they give you a flotation cost, it's 1 minus F or whatever that percent is. And 5% is a pretty common number. So $10 divided by the 111.10 becomes 9%. So the cost of preferred stocks is 9%. And it's typical that the cost of preferred stocks is higher than the cost of equity. Okay, so they're kind of just showing us a timeline of how this works. Remember that preferreds are perpetual, meaning they're infinite. So that's the sideways 8 is the infinity symbol right there. So that they're kind of just showing how that turns out to be. Okay, now flotation costs for preferreds, though, can be significant. So it says that's why we're actually using them. And remember that dividends are not tax deductible, so no tax adjustment. We just use the RPS. And we want to use the nominal or annual amount. And preferred stock is, the question here is preferred stock more or less risky to investors than debt? It's more risky. Companies are not required to pay preferred dividends. However, most will, because if you don't pay your preferred dividends, it means you can't pay your common dividends, which means it's harder to issue new shares of common stock. Okay, so that's just one small issue. Why is the yield on preferred lower than R sub D? Now, one other issue to keep in mind, though, is that corporations own most preferred stocks. And there's what they call a dividend received exclusion, which can be more than 50%, but we're going to keep it simple and use 50%. So when we factor that dividends received deduction in, that reduces the cost of preferred stock. So our 9%, once we factor in the dividends received deduction, actually goes quite a bit lower. And you can see it becomes 7.5% or 7.875 versus 7.54. R sub D is 7.5. R sub PS with the tax break for the dividend received exclusion is 7.875. Now, for common equity, I want you to think of common equity as really two things. It's the ability of a corporation to issue new shares of stock, and it's the ability of a company to take profits and reinvest them through retained earnings. Okay, and so companies can raise capital kind of both ways: sell new stock or keep your earnings and reinvest them. Either way gets you there. Now, we charge ourselves as a cost of reinvesting our earnings. So companies still charge themselves a rate for using retained earnings, which might seem odd. However, you have to think of the opportunity cost. A company can do two things with its earnings: keep them or pay them out as dividends. And companies that are consistently profitable will do a little bit of both. They'll pay out some dividends and keep some. However, every dollar kept is a dollar not given out as a dividend. Therefore, there's an opportunity cost for reinvestment into the firm. Now, the vast majority of companies, established, highly profitable companies, most will pay about a third, roughly, 30 to 40%, somewhere in that neighborhood, of their profits out as dividends. That's a pretty common approach. They still, even very profitable companies, still keep the vast majority of their earnings. So that's that opportunity cost that I mentioned. So remember that all investors are looking at that. They're going, okay, the dividends affect the value of the stock, and if the company is not paying as much dividends, I might choose to invest elsewhere. Okay, so that's kind of why we have that cost that we're going to charge ourselves. So to determine what the cost of equity is, and they use R sub S, meaning stockholders' equity. I can use the CAPM, which you looked at in a couple different chapters already. This came up in Chapter 7 and in Chapter 5, or Chapter 6, I should say, Chapter 6 and Chapter 7. So we all know the CAPM, the capital asset pricing model right here. That's one way to do it. We can use the dividend cash flow model, which we looked at in Chapter 7, or a new method that's pretty simple to use, own bond yield plus judgmental risk premium. Basically just saying, we know what our bond yield is, and we add kind of a judgmental amount for the risk premium of equity over debt. Okay, look at all three. So what most companies do is they use an average of all three. Now, of course, DCF can only be used if a company pays a dividend. The CAPM can always be used, and the bond yield plus judgment risk can only be used if the company has debt on the books. But CAPM for sure can always be used. The other two can be used only under certain circumstances. Okay, so here is the CAPM approach, and they're giving us all the data to plug in the numbers to the formula, and you can see we get 12.8. So 12.8% is our cost of equity using the CAPM. Okay, and then issues using the CAPM. Most analysts use the rate of a long-term bond as the estimate for R sub RF, and I've mentioned, most books that I've used to teach finance use the 10-year T-bond rate. Not every book is necessarily in agreement with that, but the one I see the most is the 10-year T-bond. And of course, they're just going to give it to us. They just said it was 5.6. In reality, it's just above 2%. Now, it says most analysts use a rate of 3.5 to 6% for the market risk premium. Again, that's a little bit of a judgment call of what that number is. And I've talked about beta in class before. It says here estimates of beta can be noisy. They can have a wide confidence interval. Kind of a best practice that I've seen from other books is to find a beta for a company on 3 different websites and use an average of the 3. Unless one of the numbers is way different than the other 2, you might throw that one out. But generally, a good way to do it would be just to average 3 specific numbers out for the same company. But beta is just one of those numbers, when you look it up, it could just have a very wide variance between 2 different websites or 3 different websites. So the dividend growth, cost of equity. So we'll use the dividend model now. And so R sub S is D1, the dividend a year from now, divided by P0, the price of the stock today, plus the growth rate. We've seen this formula before, came up in Chapter 7. So the dividend today times 1 plus the growth rate divided by price today is the growth rate. So D1 is D0 times 1 plus G. So I plug that all in, I get 12.4. So this example gave me 12.4. CAPM gave me 12.8. You were in the ballpark. But again, those growth rates are a little bit of a judgment call. And, sometimes companies will come out and say, here's our desired growth rate. And so you have a good idea what it is, but it's still a little bit of a judgment call. It says here that you can use historical growth rates if you believe that, that historical growth rate will go forward. You can look at analyst estimates and so on. Or you can use the earnings retention model, which is right here. This one says, the company's been earning 15% on its equity, and it's been paying out 62% of its earnings, and you expect that to stay constant in the future. You can use this to calculate the growth rate. So the retention rate divided by ROE. And so retention rate is the same thing as 1 minus payout. What percent of our earnings are retained, right? And they mention here that if the payout is 62%, the retention rate is 38%. Okay, so 1 minus the payout is 62, so retention is 38. The ROE is 15, so 5.7, close to 5.8. So that's just one way to maybe ballpark it. Okay, And then could the dividend growth approach be applied if G is not constant? Of course, absolutely it can be. This is more difficult to do. Don't necessarily worry about that for the homework. We're going to kind of more focus on the constant approach. Then the last approach, which is newer for us, is the own bond yield plus judgmental risk premium method. So we already calculated that R sub D is 10. That's before tax. Okay, that's the before tax number is 10. And the risk premium, they're just going to give it to us and say 3.2. I have another book that says it's generally between 3 to 5%. And so that other book says just use 4% as a happy medium. So I've seen anywhere ranging between 3 and 5%. So they just said use 3.2. We get 13.2. So again, still relatively close to the others on the higher side, but you can see CAPM is 12.8, dividend growth 12.4. The judgment approach is 13.2, well, the average is 12.8. So that's not a bad approach if you can use all three methods. Remember, I can only use the dividend growth if I pay dividends. I can only use the RD plus judgment if I have debt on the books. I can always use CAPM though. And then the weight. So remember that the WACC is a forward-looking number. So I don't look at what my weights are today. I look at what I expect my weights to be, the target weighting that I'm trying to achieve as I go about potentially issuing new debt, new common stock, new preferred stock, or deciding what percent of my earnings to pay out as dividends. So I don't focus on what the weighting is today using my historical numbers. I focus more on the future and what I want them to be. So they might try to trick you with that in a question or two. They might give you historical and target numbers, and you want to choose the target numbers. Okay, so our target is that we'll have 30% debt, 10% preferred, and 60% stock. So that's what we'll use to calculate the formula. Okay. But we want to use base things. It says if we don't know the targets, then estimate them using market values, not book values. So market values should always rule. Okay. So that's just one big thing to kind of keep in mind. Okay. So now let's estimate our weights, and it says here debt price was 115,372. We have 70,000 bonds. We take 70,000, the number of bonds times the price per bond. We get 80,764,000. So 80.76 million is my debt. My preferred stock price is 116.95. I have 200,000 shares. That gets me to 23.9 million. My common stock price is 50. 3 million shares. That gets me to 150 million. Okay. So market value of each then. So this is my market value. Total market value is 254.60, and then this gets me pretty close, right? So 31, if I go 32,959, that's really close to my target. Okay, so and that's pretty common for most companies, unless you're really trying to change your structure severely by doing a lot of debt or a lot of common versus the others. That should be pretty much the norm. So we'll go with the target, which is the 10% for, let me get that right. We'll go with the target rates here. So 30% is what I'm trying to say for debt, and 10% for preferreds, and 60% for commons. So, but this formula right here, that's an important formula. You'll use that quite a bit in your homework. So the WACC is kind of a long formula, but each little thing here I think makes sense. So when you see the W, that's the weight. That's the weighted average of debt, 30%. Weighted average of preferred stock is 10%. Weighted average of stockholders' equity is 60%. R sub D, we've already calculated that was 10%. The T is 25%. The R sub PS, preferred stock, was 9. And then R sub S was 12.8. Okay, so it's just a multiplying the weight times the R sub whatever, and we get 10.83 as our weighted average cost of capital. But you will use that formula quite a bit in the homework, this top formula right here. So how much influence does a company have over what the WACC is? Some things you control, some things you don't control. You absolutely do not control the market, especially with interest rates. You just have to operate within the framework of what's been put in front of you. So, if there's tax policy that change, if the Fed makes a decision, whatever international incident happens that affects the market, you just have to operate in that. Same thing with the tax rates. And the risk premium will change just depending on how people view the market. If people are thinking the market will go up or down, that'll affect the risk premium. So there's a lot of things you don't control, but you do control the capital structure policy. What's your weight for each of the three main components? You 100% control how much you pay in dividends, and you also control what kind of projects you undertake. All companies are trying to go through that process of how do we grow the company? What kind of projects do we invest in? And if I choose just riskier projects, well, obviously that will impact my cost of equity. If I choose really safe projects, my cost of equity will go down. So, most companies are kind of in the middle. They've got a basket of riskier projects, safer projects, and things in the middle. Now, the big challenge for big companies that have lots of divisions that are unique and different from each other is a WACC for the company may not be the WACC to use for a division, because some divisions may have a lot different risk than the main company as a whole. So maybe a company has several divisions. A couple are pretty safe, they're typically profitable. A couple are riskier. That's not unusual. So when you get to a really big company with several divisions, you have to be careful about that. So you might have to take the corporate WACC and adjust it for the risk of that particular division. Or if you can, calculate the WACC of the division by itself as if it were a standalone company. That could be more complicated. It might be easier to figure out just how to look at the risk-adjusted beta for the division, or I'm sorry, risk-adjusted WACC of the division versus the company. So this chapter talks about risk. There's three main types of risk that affect a company, and particularly projects. So again, think of companies as they invest in projects. What kind of risk does each project give us to deal with? And you can see what the three are right there. You'll have a few questions in your homework that'll deal with these, so you need to be aware of what they are. Standalone risk is easiest to calculate. Market risk is typically the best in most situations. However, creditors, customers, suppliers are more affected by corporate risk, so corporate risk is also relevant. And when we look at risk for a project, we want to basically figure out, especially for a company with several divisions, how is the divisional risk different than the corporate risk in terms of what the WACC should be? Did we take the corporate WACC, and then now I've got a project for a division that's riskier, so I'm going to maybe raise the WACC for that division. And then if that project is riskier than even that division's risk, I'd have to maybe adjust it even higher. So think of the WACC as kind of a place to start, and knowing we have to maybe adjust that number based on risks. Now, keep in mind that when companies decide to issue stock, you're for sure going to pay a flotation cost to the investment bank, the underwriter. Sometimes when you flood the market with new shares of stock, so think of, we've already been a corporation, we've already got stock issued, and now we're going to do another round of stock offering. And stock to some degree is supply and demand. So if there isn't increased demand for the shares, but there's more supply, we all know the math, price will come down. So sometimes capital markets will quite often see that the company issuing additional shares as a negative signal and possibly take that as a signal that the stock price will come down. So that's a challenge for companies. Issuing new stock will typically reduce stock price. So mistakes to avoid in looking at the WACC and calculating it and using it to focus more on current amounts, not historical amounts. mixing current and historical measures to estimate the risk premium, book amounts versus market amounts, incorrect cost of capital components, and then a few more things I mentioned here. We want to, again, focus on not historical, the current and the future. Okay, the current and the future. And again, the weights are a target. Companies generally have a target in mind for what percent of each component of capital do we want to have in the company. Okay. And again, we mentioned payables, accruals, deferred taxes are not sources of funding from investors. We're focusing on sources of funding from investors in the calculation.